On the first trading day of January 2026, a financial filing quietly made its way to the Securities and Exchange Commission. It was a standard filing form, required for corporate insiders whenever they trade their company's stock. However, this particular filing was from Mark Zuckerberg, the CEO of Meta, who had been selling his stock at an unprecedented pace. Over the past 18 months, Zuckerberg has sold more than $12 billion worth of Meta stock, almost every single trading day. And he's not alone in this. Jeff Bezos has sold over $8 billion worth of Amazon stock in the same period. The Walton family, heirs to Walmart, have sold more than $4 billion of their holdings in a synchronized exit. Even JP Morgan's CEO, Jamie Dimon, has sold $150 million of his stock, his first sale during his entire tenure. When the world's top CEOs start exiting the market simultaneously, it's time to pay attention. They're turning stock into cash at an incredible pace, reminiscent of the dot-com bubble in the late 90s. Yet, despite their actions, they publicly tell us that the economy is strong and the AI revolution is only just beginning. This gap between what they say on TV and what they do with their own money is perhaps the most important signal in the market right now. To understand why this is happening, let's look at the legislative developments in California. For years, California has discussed a wealth tax to fill its massive budget gap. By late 2025, the discussion turned into a real threat with the introduction of the Billionaire Tax Act. This proposed a 5% annual tax on unrealized capital gains for residents with a net worth over $1 billion. For someone like Zuckerberg, whose wealth is mainly tied up in Meta, this could mean having to sell billions of dollars in stock every year just to pay the tax. The result? Forced selling, a depressed stock price, and a loss of control over his company. So, Zuckerberg and others like him did what any rational person in their position would do. They moved. They relocated to states with no income tax, like Florida, Texas, and Nevada, ahead of the January 1st deadline. Bezos, for example, moved to Miami, saving an estimated $600 million in taxes in just 1 year. But relocating wasn't enough. They had to liquidate their assets while still living in these tax-friendly states to lock in the savings. This explains the massive wave of selling we're seeing in late 2025 and early 2026. They are offloading their stock at high prices in tax-free states to reset their cost basis, ensuring they keep their wealth intact. However, there's a much darker side to this story than just taxes. Taxes are the excuse they use, the cover story that lets them sell their shares without alarming the public. If Bezos sold $5 billion of Amazon stock and said the market was about to crash, it would cause panic. But if he says he's optimizing his tax situation by buying a yacht in Miami, no one bats an eye. This strategy allows him to sell shares at the peak without triggering a market-wide sell-off. This is the classic distribution phase of a market cycle, where the smart money sells to the dumb money. They are taking advantage of the AI hype to offload their stock to retail investors who are buying into the excitement, while the billionaires move to cash. The reality they see behind closed doors is far less rosy. They're noticing slowing consumer spending, rising credit card defaults, and shrinking profit margins in their core businesses. They understand that the AI revenue they've promised will take years to materialize. So, they're cashing out now, locking in gains from the longest bull market in history. This mirrors what happened in 1999 before the dot-com crash, when Bill Gates sold a large portion of his Microsoft stock at the peak, claiming it was for diversification purposes. He didn't mention the market crash that followed. He got out at the top, and the retail investors who bought his shares were left with losses. The same scenario is unfolding today, but on a larger scale. We are witnessing a wealth transfer from the middle class to the ultra-wealthy, disguised as a tech boom. And the mechanism they're using to execute this transfer is a legal rule called the 10b5-1 trading plan. This SEC rule allows corporate insiders to set up a plan to sell their stock at a predetermined rate, which supposedly avoids any accusations of insider trading. They claim it's all random, but there's a significant loophole. They can cancel the plan at any time or set it to only sell when the price is high enough. In other words, while the sales are scheduled, they are designed to maximize the price at which the insiders exit. Zuckerberg's plan alone is absorbing a significant portion of Meta's daily buying pressure. Every time you buy a share of Meta, it's likely Zuckerberg who is selling it to you. He's trading his paper wealth for your hard-earned cash by the billions. But the most concerning aspect of this trend is what they're doing with the cash they're getting. They're not reinvesting it in other stocks, nor are they putting it into savings accounts. They're buying tangible assets, real estate, farmland, commodities, and private businesses. Bezos is buying large amounts of land in Florida, while Zuckerberg is building a $100 million compound in Hawaii, complete with an underground bunker. They are preparing for a future where financial assets, like stocks and bonds, are worth much less than they are today. They are shifting from paper wealth to hard assets, which are more resilient in times of crisis. This is a sign of deep concern about the economy. If the people running the economy are selling their stake in it, why should you still buy in? Why continue investing in index funds, which are mostly made up of tech giants like Amazon and Meta? The smart money is getting out while the liquidity is still high. They know things you don't, like upcoming tax laws, antitrust lawsuits, and the fact that the Federal Reserve can no longer bail out the market. They are preparing for the inevitable downturn while the door is still open. Right now, the insider sell-to-buy ratio is at its highest in decades. For every insider buying, there are many more selling. In a healthy bull market, insiders buy because they believe in the future of the company. But when they're selling in mass, it's a clear signal that they believe the stock is overvalued and there's no more upside left. Despite this, retail investors continue to pour money into stocks, driven by fear of missing out and media hype. We're seeing record inflows into retail trading apps and AI-themed ETFs at the start of 2026, setting the stage for a major market correction. The media keeps pushing the narrative that the economy is booming, especially with the AI revolution. But the balance sheets of insiders tell a different story. They're selling, not buying. They're preparing for a storm, while retail investors are buying into the hype. The question is, who are you going to trust? The words of a CEO on a carefully scripted earnings call, or the actions they're taking with their own personal wealth? Even Warren Buffett, known for his cautious investing, is sitting on a record amount of cash. He's selling stocks and buying short-term treasury bills, signaling that he's not seeing any opportunities in the market. When the world's greatest investor can't find anything to buy, it's a warning sign. And when he's joined by the founders of the biggest tech companies, it's a siren. The Billionaire's exit strategy is not a conspiracy theory, it's a documented fact, and it's happening in plain sight. The most dangerous part of this trend is that the ultra-wealthy aren't just selling stocks. They're also moving their money out of the banking system. They're pulling their funds out of traditional banks and into Treasury direct accounts, avoiding banks that may fail under the strain of bad commercial real estate debt. This silent bank run is draining liquidity from the system and could trigger the next banking crisis. This move away from financial assets is part of a broader strategy of survival. The billionaires are preparing for a future where tangible assets, farmland, water, and gold, are the only things that will retain value. They know that inflation is a looming threat and that hyperinflation, not default, is the most likely outcome of the current debt crisis. They're moving into assets that will survive this new environment. You might not have billions to invest in farmland or gold, but you can still take steps to protect your wealth. Stop blindly investing in overvalued assets. Build a diversified portfolio, pay off debt, and keep cash on hand in case of an emergency. The billionaires are preparing for the storm, and you should too. Build a community of like-minded individuals who understand the risks and are preparing for the same future. It's not about surviving on your own. It's about working together. As the storm approaches, don't be caught off guard. The window for action is still open, but it won't stay open for long. Be prepared, be liquid, and be ready for the opportunity that will come after the crash. Because when the dust settles, it will be those who prepared that come out ahead.